welcome back. Well, for now, the Indian market is holding on okay, and we are not alone actually. If you look at the European markets, they have opened well in the green. The DAX is up over 1%. The French CAC is up 0.9%. The pre-market rates from US are also quite positive ahead of the Fed meeting, which will start tomorrow. Of course, a lot of macro data is also lined up in sense of Indian CPI as well as the US CPI. So we are watching out for that. But ahead of that, one space which is coming under pressure is the Brent oil prices. So Brent crude has slipped almost 3% and it's now sitting below the mark of $73 when it comes to the Brent crude prices. So that's something that we're tracking at this point of time. But otherwise, not much to worry when it comes to Indian markets because we're just holding on to that 18,600 mark, and the Bank Nifty continues to underperform. Let's try and decode that with Mayuresh Joshi as well. He's joining us on the show. Mayuresh, hi, thank you so much for making time and speaking with us. I just want to go back to the point that Aisha was making earlier, that banking has become quite a bit of crowded trade. How does one distinguish their portfolio while staying in the banking space, but maybe not the usual names?
Afternoon, Aisha. Pleasure to be on your show as well. Two things. One, I think the outperformance of banks has been pretty stellar, and I think the numbers have been doing the talking for most banks. And as a consequence, I think the kind of outperformance that it has compared to the other sectors has been outstanding. Having said that, I think the kind of normalization that one now expects, specifically in terms of NIMs, as deposit rates will start inching higher, NIMs will start moderating to a certain extent from the recent highs that we've seen. And the extent to which advances growth can happen, looking at the capital adequacy for a few of the banks. So I think the well-capitalized banks, the credit deposit ratios should show significant signs of traction. You've seen significant amount of provisioning for the system as a whole. And therefore, with asset quality pressures expected to come down, the entire ecosystem probably looks better placed than most banks across the globe, and the banking financial crisis specifically in the US markets that we've probably seen. So I think IDFC first is something that we continue holding on to our portfolios. Our own sense in terms of the retail franchise actually picking up pace for IDFC first is a huge positive. In terms of expectations of both credit costs and cost to income ratios, they should start dwindling downwards, which should start supporting ROEs and ROAs to a large extent. With retailization happening onto their balance sheet, the obvious impact that you'll probably see in terms of NIMs going forward, except the next few quarters where there will be some moderation, will be relatively better as well. And even from a valuation stroke momentum perspective, as we see it on the O'Neill lens, I think it looks better placed. But at this juncture, frankly, Anisha, I think a lot of these NBFCs are probably looking very, very good. We probably hit the peak in terms of our interest rate cycle, and therefore I think the worst in terms of NIM performance should be behind us. They are taking calibrated increases in terms of protecting the spreads and margins. With collection efficiencies expected to remain high, the expectations in terms of few well-capitalized NBFCs can do well going forward as well. So I think something like a Chola, something like an L&T Holding Finance is something that we continue to like at.
Okay, we've got retail inflation as well, which is expected to cool off further after falling below the 5% mark in April. In fact, Harsh joins in to tell us what to expect.
Well, yeah, so we're expecting a number of 4.3% basis our poll, around 4.35% if I look at the average broadly. But that's the kind of number we're expecting. Let's look at May of 2022 rather. That's the base year because the number is on a year-on-year basis. So we're looking at a base year or a base period impact of 7%. So that was the number back in May of 2022. Currently at around 4.3%, quite a reasonable decline that we are seeing in CPI, below that 5% mark, second consecutive month for in a row. Now, retail CPI inflation peaked at 7.8%. So the 4.3% currently will be good for in terms of news for the consumer. The other piece also is that demand seems to be sustaining. So really, the real positive here is that CPI is coming off despite demand sustaining, which is the key positive. Of course, the RBI also has reduced its CPI projections. Q1 earlier was 5.1%, Q1 FY24 projection. Now, they've in the recent meeting, they've brought it down to 4.6%. And you will expect to see that decline come through even in the next couple of months and play out. So hopefully that 4.6% number is met, which is the RBI expectation. Moving quickly forward, What could the risk factors be, especially the RBI looking at risk factors largely climate driven, as well as the El Nino, of course. So you're seeing possible climate related factors which could or pose a downside risk to inflation in the future. But at the moment, 4.3% is the larger expectation for the month of May 2023 year on year.
Okay, so the good news is that inflation is cooling down, and that was quite evident by the commentary that we got from RBI governor just last week as well. Mayuresh, this commodity price is cooling off. Do you think this could provide a further fillip to the margins of the entire FMCG companies, or do you think that's factored in the price already?
So to a large extent, I think it has been factored in, except what you're probably seeing in terms of an El Nino effect playing out on soft commodities like sugar and milk. I think how this plays out is extremely critical for these essential commodities. Obviously, I think if there is a shortage that probably comes through and there are some supply constraints which emanate, you're probably going to see the pass-through effect happen, which most FMCG companies obviously do, but that creates an impact in terms of volumes. But I think, as your colleague rightly mentioned, I think if the long period averages, even if you are close to that, I think the kind of rural demand recovery that we are probably seeing, and if that probably sustains, FMCG companies come back with a bang. But I think auto and auto ancillaries is something that comes on our sector rotation at O'Neill, and therefore I think these stocks which have continued doing well can continue doing so, in my opinion. So I think one of the sectors that can probably stand out can be auto and a few of these auto ancillary related companies.
Names within autos and auto ancillaries that you like?
So Maruti is clearly something that can be expected to do well. I think the longer term objectives that the management has is regaining back the market share, coming back close to that 48-50% kind of a mark. EBITDA margins should start normalizing with input costs having cooled off quite significantly. So I think the semiconductor issues largely behind, expectations in terms of more product rollouts happening over the next few quarters for Maruti, and the expectations in terms of export sales holding up, but the expectations in terms of volumes actually coming back to normalization levels as well. You obviously had a few quarters where semiconductor issues, logistics issues had their own say. But our own sense at O'Neill is that Maruti probably looks good. On the two-wheeler pack, continue holding on to TVS Motor. I think strong product mix, margins around 10-11% should continue with that. And in the auto acts, I think Lumax Auto is something that can continue delivering in terms of both products that it has got, both to the combustible engine as well as to the electrical mobility.
Right. Just looking at what else has been happening in the market. Well, of course, the index sits quiet. Haven't seen much of a move from when we started off the show, and we're status quo at that 18,679 level. Tata Motors takeaways from the JLR presentation are out. The revenue target of £28 billion in FY24 and £30 billion in FY25, and the free cash flow targets of £2 billion in FY24 and continue to be significantly positive thereafter as well. So positive commentary net is what you're seeing from Tata Motors, especially JLR. They are targeting to be net cash from FY25. Kunal, you've been bullish on Tata Motors for as long as one can remember. What next after these 560 plus levels?
So now I think we can hope for the new highs. I think if I'm not wrong, the all-time high for Tata Motors is around 620 or 650, 600 approximately for the stock. So I think that should be taken out, 605 to be precise, for the stock to be taken out. But I believe that more importantly is that the stock is not yet hit its prime, in terms of the way the chart structures have shaped up, because this is now just undoing the last 3-4 years of 4-5 years of big underperformance for Tata Motors, where from I think 600 levels the stock went down to went into a correction of almost 90% to almost as much as 60-64 odd rupees, and now it's made a comeback to that 550-600 odd mark. So I believe that the big part of the uptrend is still yet to sustain for Tata Motors. I would believe that the stock can possibly in the next 2 to 3 years even go back or come back to that 4-digit mark as well.
Wow, 4 digits on Tata Motors. That's what Kunal is expecting on Tata Motors. But let's go across to my colleague Sharad, because he's been working his phones to try and understand what the buzz is like in the dealing rooms today. And there was some large trade that happened on Man Infrastructure. Sharad, tell us what's cooking in that counter.
Well, yes, what we are gathering from dealers is that in focus we are having Man Infra, and an European FI is heard to have bought stake in the company, and the important thing is roughly 51 lakh shares have exchanged hands via block trades, and almost 1.5% equity has exchanged hands. Now the seller remains unknown, and we'll get you those details post the market hours. And importantly, there are important investors such as Swan Mutual Fund and Rekha Rakesh Jhunjhunwala invested in the company itself. Now looking at the stock performance, it's up almost 60% from March lows and currently coming at almost 14-month high levels. Now the stock specific news, if we talk about it, the recent news flow has been the company is going to develop a luxury residential project in Ghatkopar region of the MMR space. Now the important thing is the company expects a revenue potential of roughly 1200 crore rupees over the next 4 years from the phase, and also the company stated that there was a significant secured debt reduction of almost roughly 313 crore rupees over the last 1 year itself. The management commentary has been bullish for the EPC segment business and also going for an asset light business model in the residential space in the Mumbai metropolitan region.
Okay, that's the take coming in on Man Infra. Meantime, Interglobe Aviation is getting hammered amidst reports that the Gangwal family could offload about 5 to 8% stake in Interglobe Aviation. That's Indigo, of course. That is what some of the reports seem to be indicating. Remember, Rakesh Gangwal, who is one of the co-founders, had quit the board of the company back in 2022 after a fallout with the fellow founder, that's Rakesh Bhatia. And as of March end, the Gangwal family held about 16.2% stake in the airline. So it seems that they're going to ease off a little bit over there. From the current 16.2%, they may come down, or rather may sell about 5 to 8% stake. And you are seeing the stock a little bit under pressure, down about almost 2% as we speak right now. But Mayuresh, in continuation with the entire manufacturing theme, where else are you placing your bets? Any newer avenues you think which have opened up of late?
So yes, Aisha, I think the entire mid-infra stroke capital goods space still looks very, very interesting because earnings have still held up. I mean, if you look at the sequential numbers that these companies have been reporting have been exceptional. A, order wins have been extremely strong. B, the new orders that have come through are with better margins. C, the execution timelines have improved vastly, which means that a huge amount of operating leverage gets played onto their balance sheets, and that ultimately gets reflected in their ROCs and ROICs as well. Now, with such strong expectations in terms of a good order book and strong revenue visibility and operating leverage playing out, I think the earnings growth that we look at O'Neill of 20-25% can easily be achievable for most companies within the space as well. So I think within the larger mid caps, ABB India is something that we continue holding on our global focus lists. Strong numbers, expect outperformance in terms of earnings delivery to continue. But a couple of stocks within the mid-cap universe. One, ITD Cementation with management has been very, very bullish. They expect 7,000 crores in terms of revenues from 5,000 crores, a jump of almost 35-40% odd. Margins should jump from 9.5 to almost 10.5, 11 odd%, expecting 8,000 crores in terms of orders on the existing 20,000 orders that they're probably sitting on. The risk factor in terms of their exposure to the Adani Group, I think timely servicing is absolutely happening, both in terms of quarterly as well as annualized payments as well. So this is one stock which is very, very interesting from this space. And the other one is AIA Engineering. Obviously, the volume growth has been reasonable in the quarter gone by. Margins are tad bit on the higher side. They should normalize going forward. But even with 25-26% odd margins, capacity is expected to go to around 520,000 tons per annum. Expectations in terms of a very strong order book at around 800 crores, more orders expected to come their way, and absolute expectations in terms of earnings to again exceed 20-25 odd%, with very minimal leverage onto their balance sheets, leading to better ROEs. So a very interesting space, Aisha. I think ITD and AIA is something that we continue liking.
ABB, ITD Cementation and AIA Engineering, these are the stocks that you're recommending at this point of time. But Mayuresh, what about the entire real estate pack? And would you rather play directly through real estate names, or would you probably look at cement or building material counters?
So I think the right strategy, Atisha, is that a few of these players have done exceptionally well, and numbers have been extremely strong. I mean, if you go and read through management commentaries right into Q4, and where we are now resting in terms of the peak of the rate cycles, DLF obviously has been a huge outperformer as far as the entire space has been concerned. A few of these South-based players, including the likes of Soba and Prestige, have delivered a good set of annualized numbers as well. And again, I think the kind of demand that comes through specifically from IT professionals for these South-based companies still looks extremely robust and strong. So I think a few of these companies can definitely be kept on the radar. But you're absolutely right. I think the real estate ancillary space is something that can also be looked at. What we are probably expected to see in terms of good growth, expected to come through, is something that can be played out. Obviously, a couple of stocks that we continue holding on our global focus lists are stocks like a KEI, stroke Polycab. I think wires as a space expected to continue doing well in our opinion. Input cost deflation will play out very, very positively in terms of margins as well. And therefore, I think these stocks can definitely be kept on the radar. And let's not forget painting companies. I think in the second half, I think with the demand expected to come back very, very strongly, specifically repainting demand, I think that can have a huge impetus in terms of volumes. Crude prices coming off, crude derivatives coming off as well, will mean margins should remain extremely stable for these companies. And these companies throw a humongous amount of cash. I think the free cash flows are extremely strong as well. So yeah, I think a few cement players, including the likes of UltraTech, should continue doing well. A few of these cable stroke paint companies can also continue to do.
Just wanted to flag out a couple of counters which are buzzing. Look at a Sheela Foam. So it was already high at 6-7% throughout the trading session, but it's now piling on to more gains. So 13% higher as far as Sheela Foam is concerned. You also have Garden Reach, which continues the up move, and Quest Corp too is spiking a bit. On the losing side, Zomato has lost the steam, so that's now down to the levels of around 77 thereabouts. Kunal, do you track this one, Sheela Foam at all, and anything on the charts that you'd want to recommend?
No, nothing exciting on the charts. I think after months of correction, the stock is finally showing signs of revival. But again, not enough confirmation that the major downtrend is reversed for Sheela Foams. Yes, there could be just about a base building process which could probably have happened for the stock. I think 1,020,000 has been the lows the stock has tested twice. Currently, it's at 1170 mark. But the previous two resistances, the first one was at 1980 levels, and the second one was closer to 1650, 1680 mark. Those two are major resistances at play for Sheela Foam. So I think the stock would take a lot of time to try and make a comeback to those kind of levels. But yeah, I think from a short-term basis, this kind of a move just about reinstates that the near-term bottom could be in place.
Okay, that's a couple of these buzzing names right now in trade. You've got Alchem, Concor, HAL. These are all stocks which are actually seeing a bit of an ease down. Pharma is definitely underperforming. I think that after that export data, wherein you saw quite a bit of dip coming in from most of these pharma majors, pharma has been a rank underperformer. Banks, like we highlighted, even cap goods led by L&T is not doing a whole lot today. FMCG, power, cement, these are all lagging sectors. Technology, of course, is holding out well, and even telecom and oil and gas is looking smart. Idea has seen another 2% off a spurt, and remember last week was a great one for Idea. Indus Tower has been going very steady, almost a 4% move here. Bharti holding up 0.5%, and Telecom is the other winner, about a 0.5% uptick coming in over there as well. Mayuresh, what is the best way to approach the telecom story?
So I think it's a wait and watch, Aisha, very frankly, at this point of time. I think a couple of reasons. One, I think the data is highly consolidated at this point of time. I think most of the telecom players have weeded their low pricing plans and have migrated a lot of their users to the higher plans itself. The key trigger for these stocks are obviously going to be price hikes now, because I think they need to mitigate two aspects with price hikes. One, I think the kind of capex that they've got around 5G, both the bidding that they've probably done and the ecosystem needed to build 5G as a pan-India presence as well, and two existing spectrum auctions that still need to get serviced. So to a large extent, I think the trigger point in terms of ARPU increases, which should be consistent over the next few months, is something that can be a driving force for most companies within this space itself. Obviously, I think to the likes of a Jio and an Airtel, I think the subscriber base has been pretty large. They are obviously migrating a lot more customers from Vodafone Idea at this juncture. But I think the sole resting point remains ARPU increases, based on which I think the overall growth in terms of numbers can get reflected. Unless ARPU increases happen, my own sense is that it will not get reflected substantially in terms of bottom line growth. So I think a wait and watch for the sector as well.
Okay, wait and watch for that sector. But is it a wait and watch for the power sector as well, Mayuresh? Because things are looking incrementally better. But of course, we have seen multiple false start for this sector. Would you look at it seriously now?
So we did hold a few companies in our portfolios. I think we have done some element in terms of reaching our targets and therefore recommending investors to probably get out. A clear compliance disclosure will be stocks like DFC and PowerNet. So to a large extent, I think the entire story is now getting largely crowded at this juncture. Numbers are expected to be better in terms of peak power demand that we probably hit. And therefore, power consumption as a space should continue doing well, even in the next few months. Having said that, the base these companies are working on is also a very heavy base, and therefore the outperformance that we look at it from this juncture onwards is going to be a tall task for these companies. So I think only the outliers in terms of exceeding market expectations and earning expectations can continue doing well. But to a large extent, I think valuations and both price action are largely getting priced in for a whole host of stocks within the space.
Okay, just looking at some of the other than active movers in trade, and we've been highlighting as to how you're seeing a big breakout on a Delhivery, on a India, and Prestige Estates, which is sitting at a 52-week high intraday in any case, and that's managed to cross its 50 DMA as well. Kunal, let's revisit Realty, because now you're seeing newer names, join in that breakout pack.
Well, yeah, I think Prestige is the one which looks attractive at current levels as a fresh bet. The stock has confirmed a flag pattern breakout, so looks attractive in terms of a medium to long-term bet. Even the likes of Godrej Properties and Oberoi Realty, these stocks are also looking quite strong for themselves. So Oberoi Realty is the one which has managed to confirm a breakout of its 200 DMA. Godrej Properties is just about in process of confirming a breakout above its 200 DMA, as well as a breakout of its previous swing resistances. So I would wait out for a confirmation of Godrej Properties, because the stock was one of the first ones to correct in 2021. I think from 2000 to 2100, which was the high for Godrej Properties, the stock had corrected very sharply. So maybe this could be just a first process of mean reversion for Godrej Properties, and then we can probably expect the trend to continue. But then as of now, I think DLF, Prestige is something which looks attractive, and possibly even Oberoi Realty.
DLF, Prestige, Oberoi Realty and Anantraj, these are the stocks that Kunal has been positive on. But Naresh, what's the BTSC idea that you are recommending at this point of time?
So first is a buy on Indus Towers. The stock has given a breakout on early charts, also good momentum senior. Stop loss at 160, target of 170 plus. Second is a buy on BPCL, giving a short-term breakout, and the whole OMC pack looks interesting. Stop loss at 364 and the target price of 375.
At you, the BTSC trades?
So the first one is a buy on NTPC. The stock looks attractive for a target of 192, stop loss at 182. And the second is AB Capital. After quite some time, the stock has made a comeback. Closer to 175, 76 at current levels, would suggest a buy. Targets of 182, stop loss at 172.
Okay, that's the take coming in on some of those BTST trades. Haven't done anything actually, just about 54 points of an uptick is what we've seen in trade. And I just want to mark what the global markets have been up to, because they're a tad bit better than us. While of course the US futures are languishing right now and are absolutely quiet, the S&P futures higher just by a smidge. Similar is the price action for the Dow futures. It is the Nasdaq which is taking the lead with almost about a 0.5% gain, and we're pretty much, reciprocating that. Technology is the only winner, so to speak, amidst our markets as well. Asia also has been all over the place. Japan saw an uptick of about 0.5%. Korea, though, was down. Flat for Hong Kong and just marginally in the green for Australia as well. Europe, though, has started off a lot better. DAX is holding up a good 1% in the green. It's a 140-point gain that index is sitting on. CAC is holding up about 1%, and FTSE MIB as well is seeing a very strong 1% gain. It is some of the some of the markets ahead of the central bank meeting, the ECB that is, which are looking buoyant. UBS is holding up almost about 1% after completing that Credit Suisse acquisition or takeover rather. So these are a couple of highlights coming in from the global markets. For us, it's really been all about IT today and Telecom. They are the ones which have actually held out. So everything from a persistent, which is closing in with a 2% gain, LTIM, which is held out by about 2.25%. Coforge has seen a smart move, almost a 2%, 2.5% move coming in there. Naukri has held out by about 3.5%. Intellect held out by 3.7%. Birlasoft has come in higher by about 3%. Telecom, HCL, Infosys, Emphasis, TCS, LTTS, they've all been a pack of winners. I think Wipro has really been the only eyesore today amidst the technology pack at least, which closes in with a 0.5% loss. Amidst the large caps, it's been Cipla, L&T, Maruti, along with Titan, which have been the laggards. And of course, there's been HDFC Bank, ICICI Bank, Axis Bank, SBI, which have really done nothing in trade. In fact, so to speak, they've underperformed what the benchmark index has done. IDFC First and RBL, of course, along with Can Bank, have seen some recent moves. You could add perhaps a BOB as well to that pack. These stocks have managed to see almost about 1.5% kind of gains. In fact, RBL almost nudged a 2% gain as well in today's trading session. That said, it's the OMCs also which have shown some leadership. So HP, BP, both those stocks have held out very well. HPCL saw a dash of about almost 4.5%. BPCL held out by 3.5%. But on the losing side, there was also a Power Grid, there was Concor, Interglobe Aviation, which fell 2% on closing, Alchem, which lost 2.25%, and then SRF as well, which has managed a drag of about almost 3.5%. Well, that's it then. Another day of consolidation goes by. Let's see how we pan out tomorrow. For now, it's a goodbye in this edition of Closing Trade.